Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. I've spoken now for quite a few weeks about the longer term charts and explicitly the 5-year moving average, currently at 1182. This ultra long-term moving average plus the 2021 low at 1181 provided a reason for the mid-May to mid-June hesitation and aversion from going lower. I said 3 weeks ago it was worth keeping a close eye on these, and so it has turned out. These all brought beans back again once more into the teens. The two key pieces of action for the move up were provided 2 weeks ago by a pair of opening long white Mariposa's. The second punched up through some key resistances. These resistances were the combination of the base of the late 2022 descending triangle and the lesser Fibonacci line, both at 1378. This was a key resistance that turned into support. The lesser Fibonacci lines at 1389, this one was the top of the big changeover gap, then at 1400 and 1409. All these congestion levels as well, and all became supports again for an attempt higher last week at the overhead declining medium moving average, currently at 1419, and a flatlining long moving average, currently 1438. It was interesting as these two had formed a dead cross only 2 weeks prior. Wednesday last week, we even closed over both of these moving averages, the first close over these since early April. However, the market stopped short of testing the next significant resistance, the 50% Fibonacci line of the big December 2020 to February 2022 move at 1451, which was beyond it. And beyond that, another big 50% Fibonacci line of the February 22 to May 23 move at 1476. The failure to test these resistances explained why prices first pulled back below both moving averages, and then below all those previously listed supports which became resistance, which turned into supports and have now become resistances once again. This really opened up a bigger question here as to what is going on. Well, I would look at the action since May as a V bottom. Now the V bottom is usually seen as a bullish reversal pattern, but it may not necessarily lead to higher prices. You see, as I said last week, and I quote, "We have to study what the market does at the neckline, and on this formally gapping chart it can be difficult to do so. However, I suspect if there was to be a neckline near here, then it would be either the lesser Fibonacci line at 1389 or the combination a little lower at 1378. There's one subset of the V bottom that also needed to be considered, and that is the extended V bottom pattern. This happens at the end of a usual V bottom formation, but then instead of heading in one or other direction, the market starts to form a flag or pennant or even a sideways triangle in some cases. Once this pattern is completed, often a bearish piece of work, then the market resumes the direction of the original move, in this case higher. There is a possibility here for such a pattern with the previously mentioned lesser Fibonacci line at 1389 and a combination at 1378, likely as the base of any such action, should it decide to happen. So I'll wait and see how far this pullback lower will take the market, and that's the end of the quote. Well, I waited and I saw, and what I saw was that this was no V bottom with an extension, but a straight V bottom, that once it had reached its topside fulfillment as a pattern, that is in either the 1378 or 1389 areas, in this case even overshooting it somewhat, well, when it reached those levels, the pattern was done and prices dropped away. The fall so far has been down to the declining short medium moving average, currently 1361, and dipping as far as the lesser Fibonacci line at 1350. What happens now at these levels will be very interesting for this market and may have resounding implications for possibly weeks and months ahead. You see, below the resistance at 1378, we have really little support apart from the most recent 50% Fibonacci line at 1320, and I don't rate that very highly right now. We really don't have much support until the 50% Fibonacci line of the April 2020 to February 2022 move at 1290. That is why the next few days and possibly few weeks may end up shaping the market for a lot longer than just the immediate future. Chicago soybean meal. The bigger picture here had for months and months now different patterns crashing in and out of each other, but this seems to be resolving itself here. The biggest pattern had been the May to date broken, then repaired, then broken again, ascending, expanding wedge pattern. A huge pattern I'd pointed out many months ago. It was never a perfect pattern by any means, but it finally started working in late May. To assist in seeing this pattern, I highlighted it here on my daily chart in dark blue. However, the upper trend line is slowly exiting top left of my daily chart, though the lower trend line, currently at 426.40, is still here, and is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. The break lower in May below this trend line and neckline combination indicated a potential primary target that is still well off the bottom of my daily chart at an incredible 324 zone, and a secondary much harder to reach target in a 283 zone. These are the ones you can write in the back of your diary, maybe look at once or twice a year. However, the resurgence back up 2 weeks ago, prices postponed any potential targets below and instead concentrated on the top side. Thus, the market had punched up and closed over the following: the 50% Fibonacci line of the October 2021 to March 23 move at 403.60. The declining short-medium moving average, currently 415.60. The congestion of the neckline and lesser Fibonacci line at 425.90. The early April 2021 high plus congestion highs from January and February 2021 at 433.5. And finally, the slowly declining long moving average, currently 436.10. The market stopped short of testing the next resistances of the April 2021 high at 439.30, much as it did in early and mid-May, and also nearby the declining medium moving average, currently 439.10. Where does that leave us all now? Well, we have exceeded any topside targets for a double bottom, and last week I thought the market might form a handle or sideways trading area after forming the double bottom. However, the prices chose not to do that, instead opting to punch down this time through all those resistances that became supports and have now once again reverted to becoming resistances. And back into the late May to mid-June congestion of only a couple of weeks ago, between roughly 397 down to 390 even. It seems after the sharp up and down moves over the last few weeks, it seems unlikely we'll see prices try higher again immediately. But there is seemingly a limited desire to try lower as well. This brings me to my final point, which I raised 4 weeks ago. You see, my long-term monthly charts were still less than half a year gone. 2023, therefore, is set up to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve 2023 either above 471 even or under 399.10, then we'd be on. Anything in between would have a lesser outside year. Right now we're looking at a possible outside year, but we still have so many months still to go. Chicago soybean oil. The key pattern here, which I highlighted some time ago, is the late November 2022 to early June 2023 descending wedge pattern. This is easily seen as it's highlighted in purple on my daily chart. It was not a perfect pattern. It's hardly expected to be after over 6 months of continuously watching the market try and thread in between the two trend lines. That was until 2 weeks ago, when the market broke higher out of the pattern. So for such a confirmed break higher, there would be a primary target X in the 67.5 area for such a pattern, with a secondary harder to reach target X1 for such a pattern in the 78.20 area. For nearly 2 weeks, this all looks set to be on course for the primary target. However, 2 weeks ago, prices ran up into a wide and interesting band of congestion between 57.64 to 59.44, which has the old August 2011 high within it at 58.59. And a little above the slowly declining long moving average, currently 60.41. This was not far away from another congestion band between 61 even and 61.11, which includes the 2011 high at 61 even as part of it. The outcome was that prices failed in their rally and dropped down through a lot of resistance that became support. Let's turn back into resistance again, consisting of the September 2012 high at 57.64, the 50% Fibonacci line, the March 2020 to April 22 move at 56.34, the flatlining medium moving average currently 54.88, the February 2013 high at 54.15, and only stopping at what can be seen by some as the last chance for the bulls out there, the combination of the short medium moving average currently at 52.32 and the 50% Fibonacci line, this whole move up for the last 3 and a bit weeks at 52.07. Then late last week, just as easy as we fell, prices chose to rise back up again, and through all the resistance that turned once more into support, and even exceeding the previous high, pushing up through the 60 cents for the first time since early March, and reaching up to the slowly declining long moving average. However, the push up through the band of congestion between 57.64 to 59.44 looks a little too much for this short rally, and prices have gotten a little bogged down within it right now. So where does that leave us now? Well, we are still above the descending wedge pattern, so we still have those potential targets above. But anyone who thinks the recent moves we've seen don't impact those targets is deluding themselves somewhat. At best, they have put those potential targets back possibly quite a bit. Personally and consciously realizing that I do have a conservative nature about such things, I would still consider the break higher to still be a live one. But, and this is a big but I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern perhaps. In this pattern, should it come about, we would need to see prices drop back down to the lows of late May, and only then perhaps would I expand on this idea further. However, I will still bear in mind it just for now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.